Let's talk about your first step in investing. Many people feel overwhelmed by the stock market, but there's a simple way to start. Instead of picking individual stocks, you can use a beginner-friendly tool, the index fund. Think of it as training wheels for investing, exposing you to top companies with less stress. Today, I'll break down index funds in simple terms so you can confidently begin your investment journey. Ready? Please like, share, and subscribe my channel so that it motivates me to create more videos which help in wealth creation. Let's get started. So what exactly is an index fund? It's a term you've probably heard, especially if you're exploring the world of investing. But what does it really mean? What does it entail? Let's simplify it with a fruit basket analogy. Imagine you're at a farmer's market, surrounded by an array of delicious fruits. Instead of trying to pick only the absolute best fruit, which can be a difficult and time-consuming task, you decide to buy a basket that contains a little bit of everything. This way, you get to enjoy a variety of flavors and nutrients without the pressure of making the perfect choice. An index fund works in a very similar way. It invests in all, or a representative sample, of the companies within a specific market index. Think of indices like the Nifty 50, which represents the top 50 companies in India, or the Sensex, another key indicator of the Indian stock market. This approach means that when you invest in an index fund, you essentially own a small piece of many of the top companies within that index, all at once. It's instant diversification. The fund manager's job is relatively simple. They aim to closely copy the index's composition and performance, so there's no need for guesswork, active stock picking, or constant trading decisions. As a result, your returns will closely match the overall performance of the market index, minus a tiny management fee, which is typically quite low compared to actively managed funds. If the overall market rises, your investment is likely to rise in value as well. Conversely, if the market experiences a downturn, your investment will likely reflect that decline. Ultimately, it's often seen as a relatively stress-free way to participate in and ride the market's overall long-term growth potential. How are index funds different from other mutual funds? Actively managed funds try to beat the market by picking stocks, which means higher fees for you. Index funds simply mirror the market, so costs are much lower. Over time, these lower fees can make a huge difference in your returns. With index funds, you're not paying for expensive research teams or constant trading. It's a straightforward, cost-effective way to invest. That's why index funds are often recommended for beginners. Stepping into the world of investing can feel overwhelming, especially with so many options available. Where do you even begin? Why are index funds often recommended as the perfect starting point for beginners? Let's explore the key reasons. First, they're incredibly low cost. Index funds typically have expense ratios that are significantly lower than actively managed funds. This means more of your money stays invested and working for you, rather than being eaten up by fees. Over time, this difference can have a substantial impact on your returns. Second, they require almost no effort or expertise. You don't need to be a financial whiz or spend hours analyzing market trends. Index funds are designed to be a passive investment. You don't need to constantly research individual stocks or try to time the market, which is a notoriously difficult and often unsuccessful strategy. Third, they offer instant diversification. Diversification is key to managing risk in investing. When you invest in an index fund, your money is automatically spread across many different sectors and companies within that index. This diversification helps in reducing risk, as your portfolio isn't overly reliant on the performance of any single company or sector. You always know where your money is invested. Index funds are transparent, and the holdings are publicly available. This makes the process transparent and easy to understand, even for those new to investing. No hidden strategies, no surprises. What you see is what you get. Index funds turn investing from a gamble into a logical, predictable process based on the overall performance of the market. That's why they're a beginner's best friend, offering a simple, affordable, and diversified way to start building wealth. Ready to take control of your financial future and start investing? Investing in index funds is a fantastic way to begin. Here's a simple, step-by-step guide to get you started on your investment journey. We'll break down the process into easy-to-follow steps. First, you'll need to complete your KYC, or Know Your Customer verification. This is a mandatory process for all investments in India. You'll need your PAN, Aadhaar, which serves as your address and identity proof, and a bank account to link for transactions. Thankfully, Most investment apps make this KYC process incredibly easy and entirely digital, often allowing you to complete it within minutes from your smartphone. Next, once your KYC is done, it's time to choose a Nifty 50 index fund. This fund invests in the top 50 companies in India, offering broad market exposure. When selecting a fund, pay close attention to the expense ratio. Opt for one with a low expense ratio. This is the annual fee charged to manage the fund. The good news is that most major fund houses offer similar Nifty 50 index fund options, so you have plenty of choices. Compare a few before making your decision. Now set up a SIP, or systematic investment plan. This allows you to invest a fixed amount monthly, automatically. A SIP is a great way to build investment discipline and benefit from rupee cost averaging, which reduces the impact of market volatility. One of the biggest advantages of index fund investing is that you don't need to worry about timing the market. Just keep your SIP running consistently, regardless of market conditions. Remember, investing is a marathon, not a sprint. Stay patient and invested for the long term. Wealth creation takes time. It grows steadily over years, not overnight, so don't get discouraged by short-term fluctuations. It's crucial to ignore short-term market ups and downs. Trust the process of consistent investing. Start with small investment amounts, stay consistent with your SIP, and let the power of compounding work its magic for you over time. With these simple steps, you're well on your way to building a secure financial future. Happy investing!